Okay, so in this chapter, in forecasting exchange rate, we will learn how to explain firms whether they can benefit from forecasting exchange rates or not. Then we will also describe common techniques used in forecasting. And then we will then forecast performances and evaluate them. And finally, we will see how interval forecasts can be applied. So what are these? What are these? So first and foremost, we try to gather why firms would forecast exchange rate. Why do you want to forecast? So it's very important, yeah, for a multinational company that operates in several countries to be aware of the risk exchange rate may pose, yeah, to their survival, to their profitability and everything. So number one, forecasting exchange rate is important for their hedging decision. So whether a firm hedge will be determined by its forecast of foreign currency value. For instance, if you are AirAsia, you receive a lot of income from all over the world because everyone fly right around Asia, and you know Asia there's so many different currencies. Everyone fly. Their customer can be from Thailand, can be from Japan, Korea, China, Singapore, Indonesia, right? So many countries can make use or can be the customer of AirAsia. So when they book a flight ticket, they will pay in their local currency. All right. But there is one problem. One problem is when AirAsia receive all this currency, they have to pay their staff. Their staff also from multiple currency, multiple countries. For example, they might have pilots and air stewardess from Malaysia. They might have pilots and air stewardess from international countries. And lastly, they have some variable costs, important variable costs such as the jet fuel, petrol, which they need to prepare way in advance before they fly. So if they buy petrol, they might have to pay in US dollar. So imagine receiving all their income from other currency and pay part of it to salary, part of it to petrol. And all these receive and payment are all in different currencies. So in order to reduce or minimize this exchange rate risk that may actually kill the company, they need to make some serious hedging decisions. All right. So that is how companies like AirAsia them need to forecast very much. However, for different companies, they may have different goals, such as short-term investment decision. So whether or not to invest in a country or invest in a equipment in a country, we look at this short-term investment decision. Short-term meaning less than 1 year. So sometimes companies may have a sudden excess of cash. All right, like AirAsia, they they might one of these days sell off few planes. Because AirAsia is the biggest airline in the world, right? So they have a lot of planes. So in one of these days, they might decide to sell 10 planes. The moment they sell 10 planes, what happens? They will get a lot of cash. And this cash can be put anywhere in the world. They can put it bank into Malaysia's bank. They can buy a short-term investment or short-term certificate in US. or the Europe or Japan or China, they can put their money anywhere in the world basically, because the money amount is so huge that anyone will welcome such big amount of money even for a short term. So of course when they have so much money, they want to put somewhere which they can maximize their return yet minimize the exchange rate risk. That means they want to get high return, but they don't want later that exchange rate changes will impact or will reduce their earnings. That is something. All right. So the next is a capital budgeting decision. When they need money, where should they borrow from? They can borrow from any country in the world, and they will look for someone or some place to borrow where it is cheapest and also lowest exchange rate risk. Why? Because if you don't consider exchange rate risk, you may borrow cheap from somewhere, but when it comes to the time to repay the money, it may have appreciated, it may be more expensive later. So they also have to consider the potential change in exchange rate when they are making budgeting decisions. Okay, where to borrow, where to take financing. And then next is earning assessment, whether whatever they earn from a foreign country, should they remain in the foreign country or should they be taken back from foreign country to the uh, home country. So it's like Air Asia making a lot of profit in Thailand or India. Should they bring back the money to Malaysia or not? Or should they continue to leave it there to reinvest in that country? There's another decision. And finally, it pertains to long-term financing decision. So companies that issue bonds when they want to borrow or they want to invest, they might want to put this money into long term. Okay, that means exceeding 1 year. And things that exceed 1 year is subject to much higher exchange rate risk. Okay, and this one is also another thing to consider about uh, exchange rate risk and the need to forecast it. All right, so forecasting exchange rate risk, ultimately the goal is to maximize the value of firm. Okay, maximize the value of the company. How? Because by forecasting, they can make better decisions that will increase cash flow and reduce cost of capital. Right? And the decisions include whether to hedge foreign currencies, whether to invest in foreign projects, whether to remit earnings from foreign subsidiaries, or whether to obtain financing in local or foreign currency. So these are the decisions that they will come up with after coming up with a forecast. So forecasting techniques involves a few methods. Either you can implement a technical, fundamental, or market-based forecasting. So what are the differences? So technical forecasting, as you see the word technical, it always means looking at historical data to predict the future. Okay, when you see the word technical, it always use historical data to predict future. So there are big limitations to this because historical data cannot be used for long-term prediction. It can only be used for near future only. That means I can use the past 1 year data to predict the next 1 week or 1 month. We cannot use that data to predict the next 1 year. How can you say past 1 year will be equals to the next 1 year? No, it's and rarely provides point estimate of possible future value technical forecasting may work this year, but it may not work next year. Why? Because as I said, uh, pandemic hit us as at and we had lockdown in March 2020, right? We had lockdown in March 2020. But if in 2020 every company make prediction or forecasting based on year 2019, 2019 2019 as nothing. So if I use the data from 2019 to predict for 2020 or 2021, I get everything wrong, right? Because in 2019 there is no pandemic. In 2020 there is a pandemic. So whatever you forecast goes down the drain. It cannot be used. And whatever happens in 2020, can you use it to forecast 2021? Also cannot, because we did. How do we know at the end of 2020 that vaccines will be created? We didn't know. Only at the beginning of this year, only we start being aware of such vaccine, and only in middle of the year we get access to the vaccines. So how can we use 2020 data to predict 2021 data? Even in 2021 we don't know what's going to happen, right? So technical forecasting has its pros and cons, and what I mentioned, what I shared to you are the biggest consequences, right? Where past data is quite impossible to predict uh, future data if something changes, something big happens. So the next technique will be the fundamental forecasting. Fundamental forecasting is actually based on understanding relationship of economic variables and exchange rate. So like what you learned in the past, interest rate parity, purchasing power parity, international fisher effect, IFE, IRP, and PPP. Understanding this, right, will not give you uh, will not give you a precise prediction, but it will give you a better understanding of the whole picture. All right. So on top of this, by understanding this relationship, we then can use sensitivity analysis to estimate or to predict lah, what are the possible outcomes when certain factors are involved. Okay, we cannot put in all the factors because we don't know everything, but we know factor by factor what might happen next year, and by putting in these possibilities, it hopefully make your forecasting more accurate. All right, so the one technique will be to use the PPP, purchasing power parity understanding, to estimate the future, where inflation itself provide an understanding of how exchange rate might change, but inflation is also not the only factor, not be the only factor, but it can or should be included in the model. Means it influences, but it's not the only influence. Okay, get that? Because interest rate also influence, right? And also income level influence, and then expectation, and so government control. All these influences exchange rate. All right. So fundamental forecasting has its limitations also. Same as technical, they have their limitations. So for fundamental forecasting has different limitations, and these limitations includes timing. So you can predict something might happen, but you do not know precisely what are the timing of the factors that may affect exchange rate. And then the forecast of some factors may be difficult to obtain. So some countries, right, inflation rate is a data that you obtain from other countries, but some countries gives inaccurate data. All right, like certain countries they want inflation to look higher, so they set a higher inflation rate, and then with that you get a wrong data already. All right, and some income level or certain countries they don't have data. When you don't have data, it's very difficult to input these factors. And some factors are not easily quantified. You cannot put into numbers. And whatever data you use, you put it into a regression to see the relationship and sensitivity. This regression that you studied at one point in time, it may not remain constant for the entire period. Okay, it might change. So you may have to keep doing a different analysis when you want to make decision. So it's not static, right? So market-based forecasting is the third method where you use spot rate to forecast future rate. So you remember IRP, interest rate parity. You know that the current or the future exchange rate can be forecasted using current data. So how can you forecast future using current data? Because when you want to exchange for uh, foreign currency today, you will use the spot rate, right? If you want to exchange for it in the future, you will look at the future spot rate, right? Can you exchange foreign currency today for some time or 1 month later? Can we lock in the rate today? Yes, we can, and it is called a future spot rate. So if we know the rate 1 month later today, we can actually use this data to forecast, right? So it is just common sense lah. If uh if I want to buy something, let's say I want to buy uh, a handphone 1,000 today, and 3 months later it will be 900. So I know that in the next 3 months the value of this phone will depreciate by 100. So same goes with currency. I want I want uh, US dollar today, but then if I take it 3 months later, the value is different. So I know that in 3 months time, US dollar will appreciate or depreciate. So this is basically market-based forecast using existing data to forecast the future rate. All right. Okay. So long-term forecasting can be done with all these forward rates that are currently available in the market, and these are the most accurate when forecasting exchange rate for short term than for long term. So you can use it for long term and short term. Like I said, short term will involve maybe 3 months, but if I want to lock in uh, an exchange rate 2 years, or not 2 years, 1 year later, can I? Yes, you can. You just buy the forward or futures contract of a certain currency. You can. But of course, when you go into such a deal, you there might be a lot of changes in the way. So you may lock in, but the actual exchange rate by that time, 1 year later, might be different. But short term, when you think like this phone is 1,000 and 3 months later it become 900, this is when you log in today. You can book this phone 1 month later, 3 months later, but you can buy it for 900. At that time, 3 months later, the actual price might be 890. It might be different from the lock-in rate. But of course, short term, it may not be a big difference. If we log in the phone like 1 year later, log in the phone 1 year later for 800 ringgit, by the time comes, maybe the phone is only valued at 500. So it could be a bigger difference because of the available time. The time available for the price to fluctuate is larger. So long-term horizon, the forecasting might differ by a larger scale. Okay, might be a bigger difference. So uh, moving on is the IFE, International Fisher Effect. As you remember what I showed you yesterday, International Fisher Effect captures the interest rate difference and explains that how interest rate differential will show that expected inflation rate is different, and when the expected inflation rate is different, it will influence the exchange rate, right? So you can use the difference in interest rate to forecast future exchange rate as well. So understanding these three factors, you may mix up all these techniques, or you can combine all these techniques to be as accurate as possible when it comes to predicting, because everyone wants to predict correctly. All right, there are incentives to predict correctly. If AirAsia is hiring someone or finance manager, they will hire someone or they will want someone who is good. And what do you mean by good? Good is someone that can actually predict as close to the actual number in the future. So let's say Sanjita and Peso, okay, looking for the job. So they hire both. They hire Sanjita and Peso, and then they give the company give them 3 months to show themselves, to prove themselves. So both of them also good student, top student, and when they work in AirAsia, they implemented all these strategies to predict exchange rate. But then 3 months is up, then they evaluate. They look at, oh, Sanjita managed to save the company 500,000. Peizi managed to save the company 1 million. So much more. How? Because of the techniques that she used. And therefore, maybe they will keep on to Peizi and transfer Sanjita to another department, because probably they only need one who is very good at forecasting, making the right decision, and eventually benefiting the company, right? So forecasting, that this is how forecasting well adds value. All right, so all this mixed forecasting then will be used for implementing a forecast. Okay. See, multinational company may complement their forecast. They might forecast themselves, but they might also hiring forecasting service to obtain exchange rate forecast. So they might not completely believe what Peso say, because they don't want to put their eggs in one basket. That means if Peso can determine whether a company make $1 or 1 million, then she's very powerful. So whatever Peso forecast, they will get a forecasting service to verify or to get a second opinion. Right? So uh, these are the forecasts that uh, they use, and what are the differences. So taking a look at Mexican peso technical forecast, and how do they forecast using technical method? They will look at the recent movement in peso. So recently, what happened? Okay, so what happened was the peso value declined below a level in the past few weeks. So what will they predict? So this has what happened. This is what happened. T0. It has already happened as of today. This one is your forecast. This will be what will happen next. T1. Okay? So the forecast based on this historical data is peso will continue to fall because it is already below the threshold level. So this is your forecast. So fundamental forecast will look mainly on economic growth, inflation, and interest rate. So you understand all these PPP and all this, right? So you look at Mexico interest rate. Mexico interest rate is high. Oh, and inflation should remain low. Wow, interesting. So interest rate is high, inflation is low. So we probably will take the interest rate parity. Interest rate parity. So it is very attractive to invest in Mexico. Right? So if it's very attractive in Mexico, people will invest in Mexico. Therefore, the peso value will rise as US will capitalize on high interest rate by investing in Mexican security. Okay, remember when they say interest rates are high, inflation is low, we don't take the IFE, yeah, because IFE says when interest rate is high, inflation is high. Okay, so it is not IFE, it is more IRP. Okay, interest rate parity. All right, so the next thing is market-based forecast. We'll look at the spot rate and forward rate. So you need more info on this. What kind of info? So peso forward rate shows that there is a significant discount, which is attributed to Mexico's relatively high interest rate. So this is IFE. Why? Why? Because they say that currently this is the exchange rate, but in the future it will be a discount. Means peso will become cheaper and cheaper and cheaper. Means the value depreciate. Why? So if you remember what IFE says, they say that if interest rate is high, what will happen? Interest rate is high, inflation is high, right? If inflation is high, means what? Inflation is high means the goods and services in Mexico is expensive. So what they will do, they will import more than export. When Mexico import more, then the value of currency will depreciate. Right, so this is IFE. So you're looking at the forward rate, which provide a forecast of future spot rate. The peso value will decline. Right, so they said peso will increase. Peso will decline. And here, peso will decline. So methods, out of these three methods, there would be one that you will have to trust more. You cannot say, oh, I trust technical more. So, but whatever you decide on must be strongly uh backed, but must have a solid reason for you to believe so. So uh either you predict T1 peso will appreciate or depreciate. You must have a solid reason to believe so. All right. So whatever you forecast, there will always be an error. There is no forecast with no error. Right? Forecasting always have error. So I think we will continue this forecasting error after a short break, if that's okay. All right. We have a 10 to 15 minutes break, if that's okay with you. Hello. Hello, are you here? Hi, everyone. Can you hear me? Yeah. Uh, shall we have a 10 minutes break? Okay, yeah. So I'll be back in 10 minutes. In 11, 1, 7 p.m. All right, welcome back. If you are back, raise your hand, please. Thanks. Okay, moving on to forecasting and possible errors. Yeah. So whatever you forecast in the future it won't be completely correct. So we always make allowances for errors. So in terms of errors, we can actually measure how is your forecast compared to the actual value when the time comes. All right, that's number one. And you can also split it that your error cannot be completely wrong. It can be wrong at the certain period of time when the fluctuation or exchange rate is more volatile, and it can also be better forecast during normal period of time. So you can split it to different time horizon. So moving to the next slide, you will see that this is the percentage of absolute forecast error of British pound over time. So you can look at 1, 2, 3, 4 of 2005. What is this? It's the first, second, third, and fourth quarter. So you split the time horizon by 3 months, every 3 months. So if you look at first and third of 2005, first and third quarter, you can see that this number is very high. This percentage here is very high. Means what? Means the error that they predicted compared to the actual exchange rate, there is a big difference. Okay, so let's say they predict something will happen, but then they got it wrong. Okay, this is the difference in forecast versus the realized value. As for 2008, first and second, you can see that the error is very low. Error is very low means they forecasted fairly correctly, quite correct. And even 2007, their forecast error is quite low, between 1 to 2.5% only, quite low. All right, so the lower the error, the better the forecast. So as you can see, forecast error is also influenced by volatility. You can see that if the currency is higher or more volatile, the forecast error is more likely to be high, right? Because if the volatility is high, means it can go up and down quite significantly, and therefore it's more difficult to predict. But like yuan, Chinese yuan, the volatility is considered the lowest, right? The lowest. So when the volatility is lowest, the forecast is slight error only. So that is why a lot of firms they like to manufacture or they like to do business in China, because with that the cost of production can be properly forecasted. So why iPhone makes phones in China? Because they know that whatever they input, whatever they pay for, and whatever selling price they wish to sell can be easily and confidently forecasted. So they know what is the production cost. They know the production cost has very minimal exchange rate risk, because even they can forecast, they might forecast wrongly, but the mistake is not huge. Okay, the error that they get is not large, it's not significant. Therefore, they are more confident to produce something or to sell something in China. Okay, it's easy to predict, but the rest of the world is a different thing, right? So to go into more detail, you can actually create a model for testing forecast in comparison with the actual exchange rate. So if ST is the spot rate at time T, how can you forecast? You create a model with all the possible variables that may influence ST. So ST, how to get the spot rate at time T? You need to take A plus AF T minus 1 plus any possible error. Okay, so you put this data in, you may be able to forecast your ST. So if you want ST or S2 or S3, means two months from now, 3 months from now, or 4 months from now. How? You just need to put in the numbers here and you will be able to forecast. Of course, this one is something you don't know because this is the error. This is something that might go wrong. Okay, so the first and second variable will be important in order for you to estimate ST. All right, so you can use graph, you can use any possible forecast bias over time. So what does it mean by forecast bias? So in the past, maybe you predict that it is normal, but then you found out that, oh, this country is not normal. When it's not normal, you have to find out what is not normal about it, and you find out there is a certain bias to it. That means it doesn't follow what you learn, doesn't follow the conventional theory. You might have a new theory to it. So you input this theory and it will help you to forecast better. All right. So moving on. Yeah. So this is what the line is when you put in ST equals to A0 plus A1 F what so on T minus 1 and things like that. So you have this formula and you can create the straight line. The straight line is actually the forecast. And the forecast is based on what? Forecast is actually based on the actual outcome. So actual outcome is this, and this 6, 7, 8. So this is the actual. And whatever straight line that you draw is your prediction. So you predict that if value of US dollar is this, the realized value is so on. All right, but whatever you predict, there might be a certain bias. You say, hey, how come you predict like this? But most of the time, it is below the line. So when there is a certain bias, this line is wrong. You might have to redraw your line by incorporating the bias. So you can draw a better line. Okay, you can draw a better line, which is the line number 2. All right. So this is perfect if there is no bias. But when you find out that if there is a certain bias, so you can redraw to a more suitable line to forecast the exchange rate. Okay, so whatever methods that you propose to forecast, there will not be an accurate or perfect one, but there will always be a better one. So you, in order to implement a better model, you can compare the forecasting method. All right, you can compare whatever that is on exhibit 6 here. Okay, so if you are the manager, you are the boss, do you trust this if this line is drawn by Sanjita? Okay, Sanjita, and this line is drawn by Peso. So whose line should I go with? Sanjita's model or Peso's model? Sanjita's one is based on the perfect forecast line. Whatever she learned in her degree. But Peso's line is based on whatever she learned plus the bias that she thinks she needs to put in. So if you take on Peso's line, it should provide a better forecast. So that is how you compare. And so in some cases, neither forecasting method may stand out superior when compared graphically. So in certain case, I may say Peso's line is better. But if I compare with the whole world, this is just one country. If I compare with the whole world, perhaps Sanjita's line is better, right? So there's no one method is perfect or better than one another. If you want to compare all together, lah. So it can be a different model for different country. All right. So forecasting will always have relation to market efficiency, and we talk about market efficiency, there will always be these three forms of efficiency: weak, semi-strong, and strong. All right, this one we already learned before in introduction to investment, because everyone wants to predict something, but when you predict, the prediction outcome or the method you choose to predict is what you believe in. Do you believe that the market has weak form efficiency, or is the market is having semi-strong efficiency, or is it having a strong form? So weak form is when all the exchange rate is already reflected in today's exchange rate. So in the past, whatever in the past already reflected in the current price. Semi-strong is not just historical info, but recent as well as fundamental information. All right. A strong form will be not only all the information, but there will also be private information that will be reflected in today's exchange rate. All right. So the use of recent volatility level can be incorporated into forecasting exchange rate volatility. So previously we forecast the S, the rate. We want to forecast the rate. Okay, like today is 4 ringgit to 1 US dollar. Next month will $4 and 4 ringgit and 10 cent to 1 US dollar. 2 months later is 4 ringgit and 30 cent. That is the rate. But now we want to go a step further. We want to forecast the volatility. Volatility is we want to forecast the movement. We don't care about what it will be, but we want to know how much it might change. It might be higher or it might be lower, we know, but how much? Can it be 10% or 20%? All right. So by forecasting volatility, it can also give you a better prediction of the exchange rate altogether. All right. So volatility, they always look at historical pattern. So why people like to use US dollar in all international trade? Because US dollar, uh, I think in terms of volatility, they are less volatile. That means they will not change significantly over time. All right. Volatility is low. Therefore, certain currencies are always preferred, like euro, US dollar, yen, Chinese renminbi. And why they don't use Malaysian ringgit? That's the reason. Why they don't use rupiah? Why the whole world don't use rupiah or Malaysian ringgit? When you bring ringgit to travel, it's very dangerous. When you want to holiday in Thailand, you bring ringgit to Thailand, it's useless. When you go to Thailand, you want to pay something, you say, can I use ringgit? Thailand may say, no, I don't use ringgit. They say, it's the same one, let's convert. Then they say they don't accept. Why? Because when you convert to them, they take ringgit and the next day they sleep, they wake up, they go to the bank to exchange, the rate might be different overnight. Right? But if you bring US dollar, Uh, I think if you really have no cash, you have dollar, they will accept happily. Why? Because they know US dollar is quite stable and US dollar is widely accepted, right? So yeah, you can see the difference in action. Why people accept certain currencies, they do not want to accept certain currencies. All right. So in conclusion, when we talk about estimating volatility, this is a very much more advanced model where in most times, right, you will learn in a higher level, usually in your master's or your PhD. All right. We will look into estimating, forecasting volatility. Okay, so in summary, this whole chapter we talk about the importance of multinational corporation needing to forecast their exchange rate because it may determine and they will help making decision in hedging their payables or receivables, decision regarding the short-term and long-term financing, capital budgeting, and so on. All right, so the most common techniques are technical, fundamental, market-based, and mixed techniques. However, each technique has their limitations. Okay, so forecasting methods can be evaluated. How do you know that your model of forecasting is good or not? You have to compare what you forecast to what actually happened. All right, and to be meaningful, you don't just compare within one period. Like the example I gave, Sanjita and Peso, over 3 months. 3 months is actually not good enough. Probably give them 1 year. So over a 1 year period, you split that period into 4 quarters. So then you can see the comparison of prediction versus actual. And always think that there is possible bias that affects accuracy. And when you want to compare uh, two currencies, this error should be uh, divided by the actual. So forecast should be the differences between forecast and actual should be divided by the actual value to control for differences. All right. So basically, this is the end of this chapter. Do you have any question?